4 venues can legally print 4 different prices for the same stock tonight, and none of them would be breaking any rule. Not a bug and not an accident, but a regulatory window that opens December 6th, while almost nobody covering it has actually read the rule that makes it possible. This film is about that rule and about the $382 billion market that already proved the demand 5 years before Nasdaq ever showed up. Start with the paper trail rather than the press release. The SEC's own approval order, dated April 10, 2026. Nasdaq's original filing from January 13th. Blue Ocean's investor deck, presented to the industry in March. A rival exchange's own order from the Commission, dated August 14th. 4 documents and 4 dates, and not one of them written for a headline. Give Nasdaq's case its due first, because it is not a weak one. Investors across Asia want to trade Nasdaq names during their own business hours, and right now they cannot because the exchange is simply closed for most of their working day. Digital asset markets already run around the clock with no session bell at all. Nasdaq's own filing says it wants to compete for that order flow and to position itself favorably to participate in markets that trade digital assets too, once that becomes possible. The demand is real, and I am not disputing that part. Here is where I depart from the coverage. Every wire story treats December 6th as the day overnight trading begins, and one outlet even framed it as a race to compete with round-the-clock crypto. It is not a beginning at all. December 6th is the day the exchanges are finally let into a session someone else has already run since 2021, and their own numbers sit in a presentation deck that almost nobody covering this story has actually opened. I pulled that deck myself and read the numbers off it directly rather than off anyone's summary. Blue Ocean ATS ran $5.95 billion overnight in 2022 and $31.7 billion the year after that, $124 billion in 2024 and $382 billion in 2025. Roughly 64 times the volume in 3 years through one single venue, while no exchange competed for any of it, and no headline covered any of it either. That scale concentrates hard, and this is the part nobody selling the global access story ever mentions. Of 8,632 symbols that traded on Blue Ocean, at some point that year, the top 10 carried 42.1% of the dollar volume against just 22.8% of the share count. Tesla alone was $77 billion of that book, and Nvidia was another $58 billion. 2 tickers carrying more than a third of the whole $382 billion market. One flag before I lean any further on those numbers, because it cuts against my own tidiness, and I would rather show it to you than bury it in a footnote. Blue Ocean's own bar chart of its 10 biggest names sums to about $271 billion, and that does not cleanly reconcile with that same slide's 42% figure applied against the full year total. Both figures come from the identical company deck, so I cannot referee between them from outside the firm, and I am not going to pretend that I can. Either reading still leaves the concentration real. The SEC's own comment file names a different concern, and it is worth hearing in its own words. One commenter told the Commission that retail investors do not have the resources to monitor their portfolios 23 hours a day and would be put at a real disadvantage against institutional firms. Another called the current close a vital cooling-off period that lets the market digest news before the next session opens. Nasdaq's answer is more disclosure rather than fewer hours, And whether disclosure is the right fix for a market that never sleeps is a fair question this filing does not actually answer. Here is the mechanism. The consensus framing skips entirely, and Blue Ocean states it in its own words with a bluntness I did not expect from a company that benefits from it. Quote, "Exchanges cannot operate when the SIP is closed, and an ATS can operate outside SIP hours, and this is the regulatory window that enables Blue Ocean ATS." End quote. A company explaining on the record exactly why its 5-year head start exists. The SIP is the consolidated tape, the utility that merges every exchange's quotes and trades into one public feed and produces the national best bid and offer. National securities exchanges have to publish to it in real time, and alternative trading systems do not. So for 5 years, the one venue type allowed to trade all night has been the one venue type never required to prove its prices to anyone outside its own subscriber base. Blue Ocean did not discover a loophole. That is simply the rule as written. Late June 2026. The SEC approves amendments from both tape plans that extend SIP hours to near continuous coverage running Sunday night through Friday night with one maintenance hour each day. 6 industry test weekends run through early December, and production launch is set for December 6th. Nasdaq cannot even set its own timeline here because its own rule requires a further filing confirming the SIP is actually ready before the night session can open at all. 24X National Exchange has run an approved daytime extended session since last September, and its own night session sits fully built, waiting on that identical trigger. NYSE Arca has now lined its own overnight filing up to the same December date. Nasdaq's own approval order concedes the point outright. At least 2 other exchanges had already obtained commission approval for extended hours before Nasdaq had even filed its own application. 3 exchanges sharing one utility and one shared launch date. Now the part that actually matters for execution. Nasdaq's own rule filing states plainly that outside regular trading hours, most aspects of Regulation National Market System do not apply, including the prohibition against trade-throughs, and that the night session will feature limited functionality to reflect that inapplicability. Read that again slowly. Nasdaq is telling the Commission in writing that its own order protection stops working the moment the sun sets. Here is why, and it is arithmetic rather than opinion. Rule 600B88 defines regular trading hours as 9:30 a.m. to 4 p.m. Eastern. Rule 600B105 defines a trade-through, the thing Rule 611 exists to stop, as something that can only occur during regular trading hours. So outside that 7-hour window, the term trade-through has no referent at all. There is nothing for the rule to prohibit, and 9 p.m. sits well outside that window on both sides of the clock. This is not one exchange's convenient reading of its own exemption. 4 months later, in a completely separate proceeding, the SEC recorded a rival exchange, 24X, answering a critic in nearly identical language when it applied for its own overnight relief. Rule 611 currently only applies during regular trading hours. 2 exchanges and 2 separate filings 4 months apart, and that is independent confirmation of the same reading rather than an echo of it. Picture the actual moment this produces. It is 1 in the morning, and a smart order router somewhere is deciding, in microseconds, which of 4 live books to send a Tesla order to. Nasdaq's book, NYSE Arca's book, 24X's book, or Blue Ocean's book. Nothing in any rulebook requires that router to even glance at the other three before it commits. Here is what that means concretely, spelled out in full. From December 6th, Nasdaq's night session, NYSE Arca's overnight session, 24X's night session, and Blue Ocean ATS could each be quoting and trading Tesla at the same moment at 4 different prices, and not one of them would be violating the order protection rule that would stop exactly that during the day. No venue has to check another venue's book before it executes. A broker still owes its customer best execution under FINRA Rule 5310, and that duty does not vanish at night. But it is reasonable diligence checked after the fact rather than a point-in-time block on the trade, the way Rule 611 works during the day. What actually changes on December 6th is not the rule itself, but the head count. 4 separate order books, unlinked, trading the same names at the same hour for the first time at exchange scale. I should concede what actually holds up in the skeptic's case, because it is real, and I am not going to talk around it. The most liquid overnight names already trade tight, and on Blue Ocean's own record session, average spreads on its top 12 symbols ran from 0.03 of a basis point on the tightest name to under 2 basis points on the widest one. That is a 97% compression from 4 years earlier, and I am not going to dress that improvement down. But NYSE's own 2025 data on the broader overnight tape tells a different story entirely. Frequently traded names average 28 basis points overnight against 20 during the core session, and the top symbol on a typical night trades more than 5 times the volume of the name ranked 6th. Both figures are true at once. A dozen mega-cap names get excellent execution already, while everything else on that tape gets a materially worse one, and adding 3 unlinked venues does not blend those 2 populations into a healthier average. Run the arithmetic on one clip because a number that stays abstract never actually lands. A $10 million overnight order in Tesla clears 5 basis points worse than the best quoted price on a venue the router never checked, which is $5,000 on one order, on one name, on one night. Small on its own, but it does not stay small at scale across a desk running recurring overnight flow in the names that already dominate this book. So a desk already routing overnight orders through Blue Ocean should ask its broker in writing exactly how the smart order router handles the night session. Once Nasdaq and NYSE Arca are both live, does it check all 4 venues before executing, or does it default to whichever one it is already wired to? Most brokers probably cannot answer that cleanly yet, and a router that names one venue by default with no stated plan to poll the others is the answer that should worry a desk. I went looking for a clearing infrastructure hole to match the gap in trading hours, and I found the opposite. The central counterparty guarantee behind these trades already runs 24 hours, 5 days a week, live since late June, well ahead of the December launch. The regulator's own filing is candid that this is a live process rather than a finished one, and that any performance issues attributable to the extended hours will trigger further analysis and remediation. But the basic plumbing works today, and this confound simply does not carry my thesis the way the trade-through gap does. Second, I cannot rule out that dealers close this gap faster than the regulatory reading implies. More than 10 dedicated overnight market makers already quote 2-sided prices on Blue Ocean, and arbitraging liquid names across venues is a decades-old trade for a professional desk. If the same dealers make markets on all 4 venues at once, prices could converge in practice with no rule anywhere forcing it. My honest read is that this holds far better for the dozen names that already trade tight than it does for the long tail, where fewer market makers are likely to show up at 2 in the morning. Third, this is genuinely new, and the regulator says so in its own required warnings. Nasdaq's approval order forces new customer disclosures, stating that trading during the night session is novel and may present unforeseen risks, and that other key financial market infrastructure companies may be closed and could cause delays in settlement. A regulator requiring an admission like that is not proof anything actually breaks. It is an honest concession that nobody has run 3 exchanges against one dominant incumbent at this scale before. Here is what proves me wrong, named before anyone else names it, because a thesis that hides its own falsifier is not a thesis worth trusting. If the Commission extends order protection into the night session, the mechanism of unlinked books disappears by rule rather than by market behavior, and this whole story becomes an ordinary capacity story. One commenter on Nasdaq's own filing already asked for exactly that, and the Commission has not ruled it out. There is also a genuine market test, and it is checkable early rather than years from now. Watch whether published spreads across the 4 venues on the same names at the same moment actually widen relative to the blue ocean baseline that already exists. 10 names, the ones that already carry the concentration, over the first 30 trading days after launch, since the long tail stays too noisy to read that early. 10 names, 30 trading days, 1 clean test. The third falsifier is more mundane, and I almost missed it entirely. December 6th itself could slip, and the SEC's own August order on 24X builds a formal backstop, a contingency exemption that only activates if the tape plans miss the deadline, effective the following January. A regulator does not build a break-glass date for a deadline it genuinely considers safe, and that alone is a tell. If the date slips, my mechanism does not break. It simply waits for the tape to actually go live. One more thing, kept deliberately separate from the thesis above. The SEC separately proposed rescinding Rule 611 and Rule 610E entirely across the whole market, citing routing technology that has reduced the need for a regulatory backstop at all. And that comment window closed the day before I finished writing this. It is not framed as an overnight specific fix, but FINRA opened its own comment file 11 days later asking how best execution guidance should change for extended hours, specifically in direct response. And if Rule 611 goes away for the whole market, then what I am calling an overnight anomaly may be an early look at where daytime trading is headed to. If you take exactly one thing from this, take 0, because that is the number of rules requiring any of these 4 venues to check another one's price once December 6th arrives. The mechanism is definitional rather than a choice anyone made about this particular session. And here is what would prove me wrong on the record. The Commission extending that protection into the night, or spreads across the 4 venues, simply failing to widen over the first 30 trading days on the names that actually matter. 10 names carried 42% of a $382 billion market last year, and starting December 6th, up to 4 separate venues can each legally print a different price for those same 10 names on the same night, while somebody pays the spread between them. So here is the question I would put to any principal running a book through that window. Whose price counts, and is anyone actually required to check?